Hey folks, this is Jerry. We're going to work a big problem for chapter 2. So this is your first kind of look at most of the steps in the steps in the accounting cycle. Okay, so for this textbook that we're using right now, step 1 is to analyze the business transactions, and that's covered in chapters 1 and 2. That's where you figure out what's happened, which accounts you're going to debit and credit, or increase and decrease. The second step in the accounting cycle is to make journal entries, so journalize the transactions. That goes in the general journal. Usually it's a page reference. Like J1 would be page 1 of the general journal. One of your homeworks has that page reference in it, I think. On the software, you're going to need to use it. Just writing it out, you don't need it. Okay, so you learned how to do the journal entries in chapter 2. And the third step is to post the journal entries to the general ledger. So that's in chapter 2. Step 4, prepare a trial balance. You're going to do that in chapter 2. We're going to journalize and post adjusting entries in chapter 3. We'll prepare, notice that we prepare a trial balance in this chapter. After we do adjusting entries, we'll prepare an adjusted trial balance. And the adjusted just means that it includes those adjusting entries. We're going to prepare financial statements then. So chapter 1 and ongoing, the financial statements were introduced. A simple income statement is prepared first. That was in chapter 1. More complex is covered in chapter 5, so get ready for more. A statement of retained earnings, the simple version is in chapter 1. Balance sheet, a simple version is in chapter 1 and more complex in chapter 3. Okay, so you prepare the income statement first, then the retained earnings, then the balance sheet, and everything flows together. After that, in chapter 4, you're going to learn how to journalize and post closing entries, and then we'll prepare a post-closing trial balance. So you've got 3 trial balances eventually to do. A regular one after journal entries, an adjusted ones after the adjusting entries, and a post-closing one after closing entries. Okay, so for this particular problem, the specific steps that we're going to do is we're going to set up T accounts with beginning balances. All right, so what I'm going to do here is I'm going to go in here and look at my information for my sample problem. And I have that Bent and Wink opened the law office on July 1 of 2000 whatever year. On July 31st, the balance sheet showed these balances. So when I go back and I'll look at step 1, I'm going to set up T accounts with those beginning balances. So I'm going to look here. I want a T account for cash that shows a 4,000 debit balance. And I'm going to go to T accounts, and I've got my beginning balance here of cash, 4,000. How about if I bold them as we cover them? Maybe that'll help. The next one is accounts receivable that, as you know, has a debit balance of 1,500. So I'm going to go to accounts receivable, debit beginning balance 1,500, bold. Supplies inventory is an asset on the balance sheet. It has a debit balance of $400. So I have my beginning inventory of supplies at $400. Whoops, I want bold. Equipment has $5,000 balance. That also is an asset account. Let's see, did I keep going down? Yeah, I did. Okay, so equipment has a debit balance of 5,000. Accounts payable is going to have a credit balance of 4,200. So I'm going to come up here to accounts payable. My beginning balance there is 4,200. Notice how I've kind of organized the T accounts. I've organized them according to my basic accounting equation. Assets equal liabilities plus equity, and equity includes revenues, expenses, and dividends in addition to your common stock and your retained earnings accounts. Okay, let's keep going. We just did accounts payable. All right, common stock has a credit balance of $6,000. So I can put common stock credit balance there, $6,000. We've taken care of it. And retained earnings has a beginning balance of $700. So that would be a normal credit balance for retained earnings, and we've done it. All right, now we are going to look at our transactions. The first transaction is we collected $1,400 of accounts receivable that is due from clients. So what that means is that we have looked, we see we have $1,500 up here of accounts receivable, and we have collected now $1,400 of it. So I'm going to go to my journal entries, and I'm going to make the journal entry to show that cash increases because I received cash of $1,400, and accounts receivable will decrease because the customers paid us the $1,400. So to increase cash, we debit. To decrease accounts receivable, we credit. Okay, so those are bolded. We've done that entry. Okay, the next one. We paid $2,700 in cash for the accounts payable that was due. So if we look up here at our trial balance, we had accounts payable $4,200. So we have now paid, on the 3rd, we paid $2,700 of that $4,200. So my journal entry to show that I'm making payments on my accounts payable, I'm going to decrease the liability accounts payable with a debit of $2,700, and I'm going to decrease cash because I'm writing a check and paying them off. So I credit cash $2,700. All right, number 3 says that we're going to recognize revenue of $7,900. Recognizing revenue means we make the journal entry. So we've earned some revenue this month, $7,900, of which $3,000 was collected in cash. Looks like I have another typo I need to fix. And the balance is due in September. Okay, so we earned revenue. The clients have paid part of it, and the rest of it will be due in September. So to show that journal entry, number 3, the accounts receivable is the difference, $4,900. So you know what I pretty much like to do with that is I like to draw a box around it and yellow it, or just draw a box if I'm doing it in pencil and paper, and show that I had to find that number. Sometimes I also italicize it, I think. Okay, and then we're going to debit cash for the $3,000 we got because that increases cash. We're going to credit revenue for the revenue that we earned, the full $7,900, because he earned it all in August. Okay, so that journal entry is now done, and I can bold it. Transaction number 4, we purchased additional equipment for $1,000. We paid $400 in cash and the balance on account. Okay, so our journal entry there. We're going to increase our equipment account because we bought some more equipment, $1,000. I'm going to credit cash for the cash that I spent, the $400. That's my down payment. And I'm going to make payments on the remaining $600. So that goes into accounts payable. And all of those will be bolded. Number 5, we paid salaries of $3,000. We paid rent for August of $900, and we paid advertising of $250. So we paid some expenses. So I'm going to debit each expense, and that will increase the expense. Salary of $3,000, rent of $900, advertising of $250, and we wrote checks for all of them, so I'm going to credit cash for $41.50, and we'll bold that. Okay, number 6, we declared and paid a $450 cash dividend. So Benton Wink is the owner of the law office. He's the shareholder, so he's going to get $450 in dividends for the month. So we're going to debit or increase the dividend account, and we're going to credit the cash account for $450 to show that we wrote a check for dividends, and we'll bold it. All right, transaction 7, we received $2,000 from Standard Federal Bank. The money was borrowed on a 4-month note payable. So we went to the bank, we said, hey, we need a little bit of working capital. Can I borrow $2,000? And the bank said, sure, you're going to make good money. We can do that. So on August 7th, we debited cash and we credited notes payable for the $2,000. The note is a written promise to pay within a certain amount of time. Usually interest is charged and you're making payments over time. The accounts payable is non-written, and you just agree to pay usually by the end of the month. All right, so let's bold our note payable. And our last transaction is we incurred utility expenses for August of $180. We haven't paid them yet, so they're on account. So we're going to increase in accounts payable. We want to record our expense in August because accrual basis accounting tells us that when we incur an expense, we record it in the period it was incurred or used. So we're going to debit utility expense, credit accounts payable, and we'll bold those. All right, so those are our journal entries for our 8 transactions. Let's go back to the first tab here, specific steps in the accounting cycle. We set up the T accounts. You know what? I'm not doing what I'm supposed to do. We were supposed to prepare a trial balance to make sure that the numbers we put in the T account balanced. So let's stop and go do that right now. So here's my trial balance. Notice we have a 3-line heading, the name of the company, the name of the statement, and the date as of August 1. And we put in all of our debits and all of our credits that we used. Our totals agree, so we're pretty confident that we did it correctly. Okay? All right, now, we made the journal entries. That was step 3. Step 4, we're going to post each journal entry to a T account. Okay, the actual posting is done to the general ledger. We use, for teaching purposes, a simpler method, which is just called a T account. That's all it is. So it's just a small general ledger that's quick and easy. All right, so I'm going to go to my journal entries. I'm going to come back up here to my first one. I'm going to debit on the first, I put the date. I need to debit cash $1,400 and credit accounts receivable $1,400. So go to my T accounts. I'm going to debit cash $1,400 and I'm going to credit accounts receivable $1,400. All right. Journal entry 2, I'm going to, on the August 2nd, I'm going to debit accounts payable $2,700 and credit cash $2,700. Back to T accounts, debit accounts payable $2,700, credit cash $2,700. Okay, I hope you're following. Journal entry 3, debit accounts receivable $4,900, debit cash $3,000, and credit revenue $7,900. Let's see if I can get that right. All right, we're going to debit accounts receivable $4,900. We're going to debit cash $3,000. So that's a total of $7,900, and that is going to be our credit to revenue $7,900. Okay, if we did not have a revenue account yet. Okay, so what you need to do is you need to create, if you don't have a T account for what you need, simply create it and put it in the proper place. All right, back to journal entries. We took care of August 3rd. All right, so on August 4th, we're going to debit equipment for $1,000, credit cash 400, credit accounts payable 600. So debit equipment 1,000. We're going to, I forgot what I was doing. Credit cash and accounts payable on the 4th. Okay, credit cash for 400 and credit accounts payable for 600. And the 6 and 4 add up to 1,000, so I got it. Okay, next entry, we have 3 expenses to debit, and then we're going to credit cash for $41.50. So what we're doing is we're recording all of these expenses. All right, so we don't have T accounts for those expenses. So I believe it's salary is debited for $3,000. Rent expense is debited for $900. Advertising expense is debited for $250. Whoops, right there. And our credit to cash is $41.50. All right, I think we did that right. On August 6th, dividends are debited for $450 and cash is credited $450. So dividends is going to reduce our equity up here. Debit dividends $450, credit cash $450. All right, on August 7th, we debited cash $2,000, credit notes payable $2,000. Okay, so debit cash for $2,000, credit notes payable for $2,000. And our last one is a debit to utility expense and a credit to accounts payable. So we're going to debit utility expense. We had to make that account. And I'm going to credit accounts payable. Whoops, there we go, we got it. All right, so we have finished then posting each journal entry. So the next thing we need to do is to determine the ending balance in each account. So we're going to go back to our T account worksheet. And the way you determine your balance is you're going to add up all of your debits. In this case, they add up to $10,400. Right here is where I'm seeing it. We're going to add up all of our credits. That's $7,700. So the debits, the total debits are more than the total credits. So we're going to end up with a debit balance. And the balance is the difference between the debits and the credits. So if I were doing this on the board, I'd probably do a dotted line here and then put the balance underneath it, $2,700. Okay, so you do the same thing. You've got $1,500 and $4,900 is $6,400. That's more than $1,400. The difference is $5,000, and that's our balance. Supplies inventory, we only have the one thing. We didn't recount supplies, so we leave it at $400. Equipment has a debit balance of $6,000. Okay, that's all the assets. Liabilities, we add up the credits. $4,980 is the total. That's more than your debit of $2,700, so you end up with a credit balance of $2,280. Notes payable, you only have the one, so that is your balance of $2,000. Same thing, common stock, only a balance of $6,000. Retained earnings is a balance of $700. Dividends, revenues, and all the expenses only have one thing in each of them, so that represents their balance. Okay? Next, we're going to go in after we've posted and do another trial balance to make sure that our debits equal our credits. It doesn't tell us that everything's perfect. It just tells us that our debits equal our credits. So what I did is I created a formula that went back over to the T accounts and picked up this cell reference and pulled in the balance. So here are all of my balances, and my debits equal my credits, so I'm reasonably sure I did it correctly. Okay, so if you notice on our T accounts, the retained earnings balance is what we had on the first day of August. So this is important. I want you to get in the habit of dating your retained earnings balance, because it's going to be a source of confusion when we get to chapter 4 if you haven't dated it. Okay, so just get in the habit, write retained earnings beginning balance, write retained earnings August 1st, whatever you want to do, just make sure you label it. Okay, sorry, got to get a drink. Okay, so we've done our trial balance, it balances, so now we can start preparing our financial statements. So the first one is an income statement. So we're going to prepare the income statement first. We have a 3-line heading, the name of the company, name of the statement, and the period of time. For an income statement, it's for a period of time, okay, not as of a particular day. Because revenue was earned all month, add up your expenses, they total $43.30, subtract the $43.30 from the $7,900, and that gives you net income is $35.70. Okay, I want you to note that the 2 columns we're using on the income statement are not debit credit columns. Okay, they are simply columns to add numbers. Even though the revenue is a credit and all the expenses are debits, don't think of it like that when you're preparing a financial statement. Okay, the other thing you should make note of is that a dollar sign should be placed at the top of each column of numbers and after a line is drawn. So you should have a dollar sign on the 7,900, the 3,000, and the 35.70. I can add another column in here to get the dollar signs in the appropriate place, but if I make all the numbers dollars, then every number will have a dollar on it, and that's not right either. So I'm going to show no dollars, but in reality, you should put some dollars on there in those 3 places. Okay, so back to the start. We are information here. Nope. Accounting cycle. So we've done the income statement. Now we need to prepare the statement of retained earnings, because our net income will flow from the income statement to right here to the retained earnings statement. Okay, 3-line heading for a period of time. Our beginning balance of retained earnings, remember, is the $700 we started the month with. Note the date. Add net income. Subtract the dividends, the $450. Go back and look at your T account. That's where they're all coming from. And then you have your ending balance. Notice the date for retained earnings of $38.20. Again, these are not debit credit columns. They are simply a column of numbers to add and subtract. And you would put a dollar sign on the 700 and the 38.20 only in this case. All right, back to accounting cycle. We're going to prepare a balance sheet. All right, so what I want you to notice is on the balance sheet, and that should say balance sheet, not trial balance. I'm so sorry. That's what happens when you copy and paste, and I'm really bad at that. Okay, so the ending balance of retained earnings of $38.20 is what we're going to use right here. Okay. Ending balance, retained earnings, notice the date. On a proper balance sheet, you won't have the date, but for learning purposes, I think you need to put it $38.20. Okay, so I went to my T accounts. Let's start over. 3-part heading, name of the company, name of the statement. Balance sheets are as of a particular date because we have cash on there. Cash of $2,700 is not going to be $2,700 on September 1st, most likely. It was probably not $2,700 on August 30th, most likely. So whenever you have cash on a statement, you're going to have as of a particular date. So the trial balance and the balance sheet have as of dates. Income statement and retained earnings statements have for the month or year or quarter ended, a period of time. Okay, so go to your T accounts, pick up all of your assets, and they total $14,100. Again, pick up your two liabilities. They will total $4,280. Stockholders' equity, you've got your common stock and your ending retained earnings for a total of $98.20. And total liabilities and equity add up to $14,100, which is our total assets. Okay, again, these are not debit credit columns. They're simply a way to put a column of numbers, add them up, draw a line, and show that that's the total. Okay, you're going to have a dollar sign on the $2,700 and the $14,100. Again, you're adding the two liability accounts to get total liabilities. So the $2,280 will have a dollar sign, $4,280 a dollar sign. You're adding two equity accounts to come up with total equity. The $6,000 would have a dollar sign. The $98.20 would not, because you're going to add it to the $4,280 that does have a dollar sign to get a total of $14,100 that does have a dollar sign. And notice that that $14,100 and that $14,100 agree with each other. So we're good to go. Okay, I apologize for the couple of little mistakes in there. Try to get them fixed for us. And I hope that that helped with the process of how to work out those problems. Okay, one more thing. I know it's almost 30 minutes you've been looking at this stuff. Okay, when you're working in the software for Wiley Plus and you have a long problem like this, when it comes time to make your journal entries, I would make them on a piece of paper before you ever start trying to put it into the software. In fact, I would probably do the whole thing on a piece of paper, make sure it's going to come out right before you ever start entering on the software, because the software can get confusing when you're first starting it. And I'll see if I can do a video that shows you how to do one of the software problems. Okie doke. That's it for this. I hope it's helpful. You can go back and look at it, pause it, rerun it, do whatever you need to do to learn how to do this, because this is important. Okay, bye.